Yes. Now I know what I'm forgetting. Forgetting to switch on the. Oh, it is. Okay, there we go. All right, sweet. We are all set and ready to go. Cool. So yes, I want us to start off by beginning 2.9. All right, we basically just want to revise what we have learned thus far, or what we had for homework, should I say. Okay, we obviously did 2.7 that other time. Okay, perfect. Yeah, we're just having some technical issues, huh? That was the only issue. But we did definitely do that. And remember, we did 2.5 as well. Okay, so perfect. So then let's read the question. All right, under required, it says calculate Mr. Davis' equity in his business on 31 October 2007 by showing the effect of each individual transaction on the accounting equation. Okay, and then it goes on to say it trades in clothing. The business trades in clothing. The business only started trading on 1 September 2007, okay? And by 1 October 2007, only the following balances appeared in their books, all right? Debit balances, bank, 425,000. Credit balances, capital, 325,000. Bank loan, 100,000. And then, so those are obviously relevant for the T accounts, okay? Those are obviously relevant for the T accounts. And then if we go on, it then also informs us that the financial position on 1 October 2007 could thus be shown as follows under the accounting equation. Assets 425. So immediately we know we need to plug that in over there. So plus 425,000. Okay. And under owner's equity, how much is it? 325,000. And then under liabilities, it is a positive 100,000. Okay, guys, if you had any challenges as you were going through these exercises on your own, now is the time to obviously ask me as we go through it today. Okay, so that's why we are actually going through it today together. Right. That said, the first transaction, it says Stand traders entered into the following transactions during October 2007. On the 1st of October, the owner, all right, made another capital contribution of 100,000 to his business by drawing a check in favor of his own business from his personal checkbook. He also contributed a vehicle to the value of 300,000. Okay. So which accounts were affected there? Which accounts were affected? Yes?
Bank and capital.
Bank and capital. Any others? Okay, all right, bank and capital, so we can start with that. So bank is obviously an asset. So what are we going to do under assets? Plus, yes, because assets are increasing. How much? 300. 100,000. Yes, he wrote a check for 100,000. Okay, right. And then we know that capital is obviously going to affect equity, right? So what are we going to put there? Plus 100,000. Okay, right. And then is there anything else we need to do, or can we go to the next transaction? There's the 300,000, yes. The value of the vehicle. So what do we do there? Under assets, right? Under assets and liabilities, 100%. Okay. Oh. Wait, what have I done wrong? You said liability, so that's why we were like, oh, my bad. Okay, my bad, my bad. Sorry about that. Yes, it's supposed to be under owner's equity. Right. Okay, now we can move on to the next transaction, right? Awesome. Right. On the 7th, it says the business paid back 5,000 on the bank loan. Yes? Uh-huh. Okay, because bank is affected. Okay, so this is a negative 5,000 under assets because bank is going down, and then liability is also going to go down because we are reducing our debt basically. All right. Are we all together? Are there any questions? Everybody happy? Okay, guys, at any point, if you have any questions, let me know. We slow it down, we explain what exactly is going on. I know we've done a few exercises with these, so I think I can tell you guys are a lot more comfortable now, so that's great. Okay, then next transaction on the 8th, it says paid the bookkeeper's salary by check, 9,000. Yes. So your bank's increasing and also expense. What expense in particular? Salary. Aha, 100%. Okay. You guys will now see when you did exercise 3 and 4, you now saw why I kept asking you which account specifically, because there you now had to debit and credit the specific account. Okay. Anyway, minus 9,000 under assets, and owner's equity is obviously affected here because it is salaries and wages is an expense. All right, awesome. Then we move on to the 10th, purchase trading goods on credit. In other words, we purchased what? Stock, yes, trading inventory, which is what? What is it? It's an asset. All right, so under assets, what are we going to do? Plus how much? 3,000. 25,000. Okay, awesome. And we bought that on credit. Creditors' control is going to be affected. Therefore, our liabilities is going to be affected. 25,000. Cool. Awesome stuff. Right. Let's move on to the 13th. What happened on the 13th? We sold merchandise with a cost price of 2,000 on credit for 4,500. What must happen? Which accounts are affected? Yeah. So your bank will increase because it's an asset. And then your owner's equity, because it was an expense. Yes. It's your income increased. So, and then the next one is your cost of sale, is your bank, your trading, your trading inventory increases. So you minus 2,000 and then our expenses. Yeah. What? So now I just want to know what is the income and what is the expense, the specific account. You're 100% right. So here we can put plus. Did we sell on credit or for cash? It was for cash, right? On credit, okay. So here it's going to be plus 4,500, right? Under asset. What is increasing? It's what? It's not bank because it's not cash. Debtors control, 100%. Then here, under owner's equity, what is the income he was talking about? Sales, 100%. Okay. It's just necessary that we know the exact accounts. All right. Right. Then here, we did mention that we put negative 2,000 under assets because trading inventory is going down. Then also here, the owner's equity, we're also putting a negative 2,000. Why? What expense were we incurring there? cost of sales, 100%. Okay? Let's move forward. On the 25th, what happened? On the 25th, it says, rendered services to a client for 10,000. The client paid 4,000 upfront and will pay the balance of in 6 equal monthly installments starting 1 November 2007. No interest was accrued. No interest will accrue to the client's account. What must happen there? Okay, first we must just ask ourselves, which accounts are affected? Yes. Debtors control, yes, because they're going to owe us. And bank, yes, because we're receiving cash upfront. Yes, income, which income account? Services rendered, 100%. Okay, so those are the 3 accounts that are affected. So we then say, okay, firstly, we received cash via the bank, which was 4,000, right? So where are we going to record that? What must happen?
Probably bank plus assets.
Yes, plus what?
Plus 4,000.
Uh-huh. Then we obviously need to go to owner's equity. Here you put a plus 4,000. Okay, we're done with that. Then we need to record the portion that is still owing, 100%. The debtor's control, which is the difference between the 10,000 and the, which is, okay. And then again, we also need to record it in owner's equity. And this is obviously still going into the services rendered. Okay, the income, yes. Okay. Honestly, I'm just going in. I don't know. Okay, right. Again, just so you are aware, because both of these, the 4,000 and the 6,000, were in relation to services, what you could have done and would have gotten your marks is you could have just said 10,000 here if you wanted to. Okay, but I like to split it up personally. But whatever works for you. I know our minds are different, so it's perfectly fine if you split it up. It's perfectly fine if you put it together. Okay. Then our last transaction that we had there happened on the 31st, and it says the owner took 2 pairs of shoes with a cost price of 340 each from trading inventory for personal use. Yes.
It's your trading inventory, there's an asset that's going to decrease.
Is it trading inventory? Yes, because we're a clothing business. Yes.
And then your drawing by owner's equity.
Okay. Or what's affecting the owner's equity? Drawings, and what's affecting assets? Trading inventory. Okay. Are we going to put 340?
No, it should be
680. Okay, and then here 680 for the drawings. Okay. Then obviously if you add all that up, you should get these amounts that we have over here. Okay. And if we want to verify whether we did the right things, we say to ourselves 727,820 plus 120,000. What do we get? 847,820. All right. So we know, okay, things should be 100% correct. Okay. So that was the first portion. We wanted to just calculate the owner's equity. Okay. So that was exercise 2.9. Okay. Like I said, the B side we will do it a bit later. Okay. Let's move on to exercise. That's correct, yes. Okay, so with exercise 3 and 4, what was happening there is we were now debiting and crediting the actual accounts. Now, this is something we actually didn't do in class together when we debit an account, when we credit a specific account. Okay, so we're just going to have a look at this now. So remember, when we go back to the slides that we went through in Unit 2, over here we had a list of what we are supposed to do when it comes to assets. We debit assets when they increase, and we credit assets when they decrease. All right, and then expenses, when they increase, we debit them. When they decrease, we credit them, or when we want to reverse them, for example. All right, when a liability decreases, we debit it. When it increases, we credit it. And likewise for an income, when an income increases, we credit it, and when it decreases, we debit it. Okay. Another easier way of mastering this is using this thing we call dead click. Okay, and I'm going to do it on the screen so that whoever's watching this video can see. Where's my and then I'm going to do it on the board because we're going to flip to our exercise. So yes, we are here. Okay, welcome guys, welcome. We have the debit side and we have the credit side. Okay. So here we have dead, all right, and on this side we have click. Okay, all right. Now, I know some of you may have had a so tell me, what does the D, the first D there, stand for? Anybody? Yes. Drawings, 100%. Okay. Then the next, the E stands for? Do you know? Anybody know? Anybody know? Next, the E stands for expenses. Okay. Then the A stands for assets. Ooh. It's Friday, guys. All right, and then the last D stands for debtors. Okay, so there we go. So, okay, I'm just gonna put a plus over here. Okay, screen doesn't want to behave. Let's do that then. Okay, right. All right, I'm gonna explain that shortly. Then let's go over to the other side. Maybe let me use purple over here. So the first C stands for capital. All right, the L stands for liabilities. And then the I there stands for income. And then the last C there stands for creditors. Yes. So you guys knew this. Why were you not answering me initially?
I don't think everybody knew.
Yeah, I'm sure not everybody knew, but I know some of you do. Okay, so what's happening over here? Basically, what's happening is we're saying that all of the stuff that we have here on the left, drawings, expenses, assets, debtors, increases whenever there's an increase or they occur. Okay, whenever we have drawings, we debit the drawings account. Okay, if we need to reverse, then we'll obviously credit it, or if it's going down, we'll obviously credit drawings. Does it make sense? Okay. Same principle with expenses. Same principle with assets. Whenever we buy an asset, we're going to debit that specific asset. Okay. If we sell the asset, if we return it, we're going to credit that particular asset. And same principle with debtors. Whenever somebody buys something from us on credit, we're going to debit debtors. Whenever they return something or they decide to pay that account, we're then going to credit debtors. Okay? Then we go over to the other side, to the right side, where we have capital, liabilities, income, and creditors. Same principle. Whenever these increase, we are going to credit those specific accounts, okay? Whenever they decrease, all right, or we're reversing them, we're going to debit those particular accounts. Everybody happy? So I think if you just study the acronym DED and click and know which side they're supposed to be, then you should be good, okay? And the more you practice, you actually won't need to think or draw this up. Okay, because now you'll just know, okay, this is an asset. It increases on the debit side, decreases on the credit side. All right. So, yeah, that is something that would have helped you with this exercise. But I'm sure you guys still handle business because I know you guys are a dedicated bunch of geniuses. All right. So, I'm looking at the wrong thing. Exercise 3. Exercise 3. All right, so the first transaction, actually, yes, the first transaction, actually have it on the screen. Let me just zoom in there a bit. Okay, so we all know the business here, because we all know the business here. Everybody had access to this thing, to the workbook. Has nobody seen me for the first time, right? Okay, perfect. So everybody here has been added to the WhatsApp group. Who's not on the WhatsApp group? Okay. So just remember, we have more than one person that's admin, right? Okay, perfect. Right. Everyone's admin, okay. All right, so just make sure you get added in the break or whatever, okay? So we can share documents and homework and whatever else we do. Okay, so first things first. Wise deposited 500,000 in the check account of the entity as his capital contribution. This is a business that trades in parts, okay? All right, so that's the nature of the business. So which two accounts is affected there? Capital contribution of 500,000 was deposited. The business's account, yes.
Bank and capital.
Bank and capital. So we now know the accounts. So now the question is, what are we debiting? What are we crediting? And this is where the dead click comes into play. Since I have two boards, I'm actually just going to put the one that side and put the other this side. I'm not going to write it out again because I know we now know what it means. Okay, but yeah, what are we debiting? What are we crediting? We have bank and we said capital, yes. 100%. We're debiting bank and we're crediting capital. All right, then obviously we now need to adjust our accounting equation. All right, our bank is going up by 500,000. And then our owner's equity is also going up by 500,000. Okay, then question 3, a little bit different from what we had before. There we purchased parts for 10,000 cash and received a 10% trade discount. Remember I taught you guys what a trade discount is and what a settlement discount is? Your eyes do not seem to be communicating that you remember, so I will explain again. Okay, so the value of these goods in the store are 10,000, but we have received a trade discount. Now, a trade discount is what we receive when we're doing the transaction, immediately when we're doing the transaction. So basically what they're telling us there is that we didn't pay this 10,000, or this 10,000 is not what's due, because we've received a 10% trade discount. So we paid 90%, or we owe 90% on that amount right there. So how much are we supposed to be paying? 9,000, okay? All right, so immediately we just take it as 9,000. We don't worry about the 1,000, okay? Now, a settlement discount works differently. Settlement discount, there's no mention of it in the initial transaction. So I walk into the store, I buy the goods for 10,000, all right? At a later point, maybe a month later, obviously, and the other thing about a settlement discount is I have to take the stuff out on credit, okay? Can't be for cash. I took the stuff out on credit. So in my books, I've actually recorded creditors control, 10,000 Rand, and trading inventory, 10,000 Rand. Does that make sense? Okay? Taking these things out on credit. Then, at a later point, they tell me, let's say I took this stuff out for a 6-month period, all right? Or let's say 10 months, and every month I'm paying 1,000, 1,000, 1,000. Now, the owner of the business tells me, Aubrey, you have been a great customer of ours. Here's a deal for you. We're offering you a settlement discount. If you pay 7,000 in 6 months, we will settle this 10,000, or we'll settle your account on these goods. In other words, instead of having to pay 10,000 over 10 months, if I pay the 7,000 in 6 months, then I won't owe the additional 3,000. Does that make sense? That 3,000 is now your settlement discount. Does that make sense? And another way to remember it is to say it's a settlement discount. It's a discount that I'm receiving to encourage me to settle early. Does that make sense? That's why we give settlement discounts out, because we want to get more cash flow in the business. All right? Instead of waiting 10 months to receive all our money, we get 7,000, 70% of what we wanted to initially receive, but within 6 months. Does it make sense? So that's the whole purpose of a settlement discount, to encourage your debtors to pay early. Okay. Right. Yes.
Will it say in future questions settlement discount? Because it only says here trade discount.
They will tell you it's a settlement discount or a trade discount. They always tell you. I haven't experienced a question where they ever just put it in such a way that you must then figure out whether it was a trade discount or a settlement discount. Yeah. Yeah. But they can do that. They can. I've never seen them do it, but they can. Because by virtue, and I see your hand and I'll get to you, by virtue of the fact that they could easily just say, you bought goods for 10,000, at a later point they contacted you to inform you that if you settle early, you can pay 6,000 as opposed to 8,000. All right. So the moment you start to hear settle early, and you know you bought on credit, you already know this should be a settlement discount. Trade discount, they can pitch it to you in such a way that they say the goods were worth 5,000, but we were offered a discount of 5% upon concluding the transaction. Okay, then you'll know, okay, this is a trade discount. Okay. Yes. So I've never seen it, but once again, they could ask it.
I was going to ask if they would ask you in any other way without mentioning settlement.
Yes, yes. Which you could see, I was trying very hard to. Yeah. So yeah, that's why I always try to teach the principle, because there's like a million ways they can throw it at you. All right. If you understand the principle, you're gonna get your marks. You're definitely gonna get your marks. So as we agreed here, it was trading inventory that was bought. So trading inventory is obviously increasing. So here we're gonna put T inventory. We know that trading inventory is an asset, so we're debiting trading inventory. And then we obviously bought on credit, so which other account is affected? Creditors control. Okay. And like we've seen, creditors control is a liability. Was it on cash? Oh, yes, it was cash. My bad. So which account is affected? Bank. 100%. Okay, so like I said before, here we could literally just say plus minus. Okay. And that was for 9,000. Okay, since it's only assets that's being affected. Okay. The next transaction, they said purchased on credit from Elite Equipment 40,000. Purchased equipment on credit. Yes.
So we bought 10,000 a year from house, and we got a discount. So shouldn't the inventory be 10,000?
I love the fact that you're asking this question. The moment you said we bought for 10,000, I knew where you were going. Anybody have some thoughts on that? Why are we recording it for 9? If the value of these goods is 10,000, why are we recording it for 9? Yes.
Because that's the actual amount of the thing.
That's what we pay. That's the cost to us. Remember, what do we record inventory on? On cost. Okay? So even though the value is 10,000, the cost to us was? Because in our books, we want to calculate, remember when we want to calculate profit, we're going to say income minus expenses. So we can go and sell this stuff for 20,000 and we only paid 9,000 for it. Does it make sense? Then our profit is 11,000. Imagine if we reported it on 10,000. But that's not what our expense was. Does it make sense? And then our profit will also be 10,000 as opposed to 11,000, which is not the truth. You see, so is it making more sense now? Awesome. We could even buy this stuff for 5 rand. In our books, we're going to write 5 rand. It's crazy, I know. All right. All right, cool. All right, awesome. Did somebody want to say something?
I just wanted to ask, why did you give the client a discount? Would you just also record what you physically got from him?
You would, oh, so if you were the one providing the trade discount?
Yeah, so if they said you sold it to, let's say, Pete, or just you gave him 10% discount.
So, how it would work is, remember we recorded how much we bought the inventory from. So, I mean, if we're selling it for 10,000, chances are we bought it for 6, 7, whatever, but we're not selling at the same price that we bought it for, right? That's out the way. So now we're talking about how much we sold it for. Okay? We haven't pre-written, we may have said in our minds that, guys, we like to follow a markup of at least 50%. Okay? So let's say we bought the inventory for 5,000. And we want to sell, we would want to then sell for 10,000. There's no way in our books that we have actually written sales 10,000. Does it make sense? So if we sell for 9,000, it's not going to affect anything. Does it make sense? It's cool. However, if it were, so that's a trade discount. If it were a settlement discount granted, once again, it's us giving a customer a settlement discount granted. Remember, when he walked out the store, we said we're selling these goods for 10,000. All right? So in our books, we said sales, 10,000. Debtors control, 10,000. Since it was on credit, right? Now, we obviously call him, we say, hey, if you pay in this period, we'll give it to you, we'll settle your account for 9. Now we actually need to record some adjustments. Because we've already recorded sales for 10,000 and we've already recorded debtors control 10,000. Does that make sense? So we'll see how we do that later on, but it will affect your general journal and it will affect your debtors control. We'll have to adjust the debtors control and adjust the sales. Okay. Great question. Okay. Everybody happy? Can we go on? Okay, cool. All right, so yes, we purchased equipment on credit. So equipment is increasing. We know equipment is an asset. Guys, if there's anybody who's like, I'm not really understanding, please slow me down. Okay, I'd rather make sure we all understand than push through the content. Okay, so here we are. Equipment, we debiting, because remember, equipment is an asset. So here we debit when it increases. Okay, equipment. Okay. And then we took it on credit. So which other account is affected? Creditors control. Okay. Right. And this 40,000. So our assets increasing by 40,000, and then our liabilities increasing by 40,000 because we owe more now as a result of this transaction than we did before. Okay. Then on the 12th, what happened? We purchased parts on credit. Again, parts is our trading inventory, so we know trading inventory is affected. And then we purchase on credit, so we know what's affected? Creditors control. What are we going to debit? What are we going to credit? You whispering? Who's whispering? Somebody's whispering. Am I going crazy? Is that what you're trying to tell me? Okay. So what are we going to debit? What are we going to credit?
I would say debit, trade inventory,
Uh-huh.
creditors,
Creditors control, yes. Oops. So 20,000. So assets is going to increase by 20,000. And then your liabilities is also going to increase by 20,000. Okay. Right. And we go to the 16th. Okay. And on the 16th, it says we sold parts, cash, 1,500, and the cost price was 1,200. Okay. Right. So which accounts are affected? Yes. Yes. What income exactly? Yes. And is there anything else that's affected? So we've dealt with the sales side first. Remember, we always have two double entries when we're operating under the perpetual inventory system. We have the sales side, which we've just done. Then we need to do what on the second double entry?
Cost of sales and inventory.
Cost of sales and inventory.
But we sold them cash, so it's going to be bank, not business.
Did we sell one for cash? Let's see. Oh yes, we sold for cash. Right. So that is going to be bank. Okay. Right. So which accounts are we debiting? Which ones are we crediting? Let's start with the sale side.
so debiting bank and crediting sales.
100%. Crediting sales. Okay, so assets is obviously increasing 1,500. Okay, and then obviously owner's equity 1,500. Excellent. Then cost of sales and trading inventory. What are we debiting? What are we crediting?
We're going to credit cost of sales.
We're going to credit cost of sales.
But why are we debiting inventory? Because it's going
No, you tell me. I asked the
I don't
question.
know.
You said we're crediting cost of sales.
Well, it's an expense.
Yes, it is an expense.
Yeah, so
Why? What have you come to realize? So guys, you agree with him? Should we credit cost of sales? Hands up those who say we should credit cost of sales. One hand. Oh, guys are all voting. If I don't see your hand go up. If we're crediting cost of sales. Hands up those crediting cost of sales. 1, 2, 3, 4. Okay. 5. Hands up those who are saying we should debit cost of sales. Because if we can't credit, then we have to debit. Guys, if you don't put your hand, I'm going to ask you. why, what you should do. So, are we debiting cost of sales? I want to see those things. Okay, cool. So those who said we're debiting cost of sales, you're right. Why? Remember, cost of sales is an expense. So remember, expenses, we debit when they increase. So we just, or whenever we incur an expense. Okay? So we just incurred cost of sales. So we need to cost of sales. Okay? Debit cost of sales. Let me just put COS. It won't fit. And then trading inventory. What's happening with trading inventory? It's decreasing. What happens? Assets we know we debit when they increase. So since it's decreasing, what do we need to do? Need to credit it. Okay? So trading inventory, this time we're crediting. This is why we say when you come for accounting, make sure you have had a good night's rest. Because it's just, it's just simple mistakes like these that you just lose out on. Okay? All right, and we know that cost of sales and trading inventory we record at cost price, not at the selling price. So we're going to use the 1.2. Under assets, are we minusing or adding? What's going on? We're subtracting, okay? Because we have less assets now as a result of our inventory going down. And obviously now owner's equity, we are deducting because we are incurring this expense for cost of sales. Okay? Right. Let me zoom in there. Right. Cool. All right. Then here it says paid elite equipment 3,000 on account. When you see on account, it means we had taken stuff out on credit and we're now paying towards that. Okay. So what's happening here? Which accounts are affected? And bank. Yes, money is leaving us. What are we debiting? What are we crediting? Yes. 100%. Okay. Debiting creditors control. Okay, and we are debiting. Oh, sorry. And we are crediting bank because money is leaving us. So under assets, it's going to be a negative. How much was this? 3,000, huh? Yeah. And under liabilities, it's also going to be a negative 3,000 because now we owe less than what we owed before this transaction. Okay. Right. Then we'll just do this last one before I give you guys a break. This last transaction before I give you guys a break. Is this thing charging? Okay, there we go. Right. Sold parts on credit to ASWATs for 1,700, cost price 1,300. Which accounts are affected? Yes? Yes. Yes. And cost of sales. And what's the last one? Sales. Okay. Awesome stuff. All right. And so we're going to debit debtors control because that's an asset and it's increasing. Also, according to our debt click, we know debtors increases when debtors increases or occurs, we're going to debit it. Okay, and then this is a trick, right? If we know that we are debiting debtors control, all right, we know that the opposite account that's affected is sales. So, or the other account, should I say, that's affected is sales. Then obviously sales must be credited. Okay. And I'm just saying that's another trick that you can use if your mind is like, oh, I'm not so sure what the other account is. Like if you're confused what sales is, you don't know that it's an income. That's another way to get to the right answer. But obviously, I want you to obviously master what type of account it is and also the debt click type thing, okay? Because the shortcuts, eventually somewhere, you're going to get caught out. But anyway, there we go. And then we also said trading inventory is decreasing. So again, are we going to debit trading inventory or credit trading inventory? We're going to credit trading inventory, okay? Okay, and then we obviously then going to debit cost of sales. Right, and we sold for 1,700, so our asset is going to increase by 1,700, but because of debtors, not because of bank, because this wasn't on cash. All right, and then sales is obviously going to increase our owner's equity by 1,700. Okay, then obviously cost of sales is going to decrease our owner's equity 1,300. And trading inventory is going to decrease our assets 1,300. Okay, and that's that. Okay, when we get back, we'll finish it off. But otherwise, guys, let's have our 10-minute break, and then we will proceed. Guys, and if you have any questions, as soon as you get back from the break, feel free to ask.